हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 33, which we had discussed in the previous discussion also, that is earning per share. In previous discussion in part 1 we had discussed about how to calculate the basic EPS, how to calculate the weighted average number of equity shares in case of partly paid shares, in case of fully paid shares, in case of bonus issue, how we will calculate the EPS in case of bonus issue. In today's discussion, we are continuing our earning per share, that is Ind AS 33 part 2, with right issues, how we will calculate the right issues, how we will calculate the EPS in case of right issues. Then we will discuss about the measurement weighted average number of shares outstanding during the period in case of right issue, concept related to right shares with examples. What is record date? We will discuss about the record date. We will discuss about the cumulative and non-cumulative concept. Then we will discuss the features of preference share capital. Then we will discuss the premium paid on early redemption or conversion of preference shares. This concept is we will discuss in detail along with the example. Then we will discuss the treatment of certain items in computation of numerator for basic EPS in case of early conversion of preference shares. Then we will discuss about the concept related to participating preference shares. How was the concept related to participating preference shares? How we will calculate along with the example. Then we will discuss about the measurement of diluted EPS, computation of diluted EPS. What are the procedure to compute the diluted EPS along with some important examples, determining the sequence for computing the diluted. So let's start our topic. Firstly, we will discuss the concept related to right issue. Right issue is what? It is like a bonus issue. In bonus issue, the existing shareholder will get the shares without any payment. But in right issue, the entity offers to the existing shareholder at a discounted price. Suppose the fair value of the share is 100, but in case of right issue you will get at 25 only. So right issue that shares, this benefit is only available to the existing shareholder at a discounted price. This concept is explained with the help of example. Suppose the following information is furnished by Samantha Limited for the financial year 23-24 and financial year 22-23. 2 years data is given in this example. Net profit for the 22-23 is 22 lakhs and net profit for 23-24 is 30 lakhs. Number of shares outstanding prior to right issue. Before right issue, the number of shares outstanding is 10 lakhs. Fair value of one share immediately prior to the exercise of rights. Last date to exercise the right is 31st July 2023, and on 30th July 2023 means prior to the exercise of rights, the fair value of the share, one share is rupees 32. The entity offer the right issue price is rupees 25 and they issue one share for every 5 shares outstanding. The person who is holding 5 shares, they will get one right share at a discounted price of rupees 25. You are required to calculate the basic earning per share for the 22-23, restated basic earning per share for 22-23 for right issue, and basic earning per share for 23-24. So we will discuss the concept related to right share. Fair value immediately prior to exercise of right, given in the question, is rupees 32. Rupees 32 includes the value of shares plus value of rights, right issues. Right issue is what? Right issue is an issuance of shares offered by the entity to the existing shareholder at a discounted price. So that issuance of shares is made by the entity to the existing shareholder at a discounted price. In this case, the fair value of the share is 32, but entity offers to the existing shareholder at rupees 25. So we have to calculate the theoretical ex right price, that is 5 existing shareholder having a fair value of 32 will get one right issue at rate rupees 25. Theoretical X right fair value will come out excluding the right, becomes 30.83 per share. Share allotted under right issue is 10 lakhs is the existing shareholder. For existing 5 shareholder, one right issue is to be given. So into 1 divided by 5, so it becomes 2 lakh shares. Number of shares at fair value, 2 lakh into 25, that is the right issue price, divided by 30.833, that is theoretical X right price. So number of right issues is 1,62,162. That is the right issue, actual right issue. And bonus component on that right issue is 2 lakhs minus 1,62,162. So it becomes 37,833 is the bonus component in that. Because total number of shares issued is 2 lakhs. And on that 2 lakhs, number of shares allotted, number of right shares issued by the entity is 1,62,162. And total number of shares under right issue is 2 lakhs. 2 lakhs minus 1,62,162. So bonus component on that total number of shares 37,838. So firstly we will determine the X right price, X theoretical X right fair value or price. These prices the base share quantity. How much quantity before issue of right shares, right issue prior to right issue is 10 lakh number of shares are there, that is outstanding number of shares, into fair value per share before rights. Prior to rights is 10 lakhs and fair value of one share immediately before the right issue is 30. So 10 lakhs into 32 plus right issue is one share for every 5 shares. That is 10 lakh shares are the existing shareholder. They will get one share for every 5 shares. So 2 lakh are the number of shares. 10 lakh into 1 divided by 5, it becomes 2 lakh. So number of right issues is 2 lakh number of shares. So now the X right, theoretical X right fair value price becomes 10 lakh into 32 plus 2 lakh into 25 divided by 12 lakhs, that is 10 plus 2, 12 lakh. It becomes to 30.83. This is the X right fair value. Now adjustment factor is fair value before right is 32. Theoretical X right price is 30.83. So 1.04 is the, so adjustment factor we have to find out. Fair value before right is 32. Theoretical X right price is 30.83. That is 1.04 is the adjustment factor. Now we have to calculate the weighted average number of shares outstanding during the period from 1st April 2023 to 31st July 2023, because the last date to exercise the right is 31st July 2023. April, May, June, July. 4 months time weighted is 4 divided by 12. Adjustment factor, that is bonus component, is 1.04. Number of equity shares is 10 lakhs. So 10 lakhs into 4 divided by 12 into 1.04, it becomes 3,45,946. Now from 1st August 2023 to 31st March 2024, that is the 8 months, time weightage is 8 divided by 12. After the right issue, the number of shares becomes 12 lakh, because 10 lakhs is the existing shareholder who get 2 lakhs the right shares. So 12 lakhs into 8 divided by 12, so it becomes 8 lakhs. Weighted average number of shares become 8 lakhs. So total weighted average number of shares outstanding during the period is 8 lakhs plus 3,45,946, it becomes 11 lakh. Now we will calculate the basic EPS. Calculation of basic EPS for the financial year 23-24, that is net profit attributable to equity shareholder, becomes in the question given, that is 30 lakhs for 23-24. 30 lakhs divided by WANA's weighted average number of equity shareholders, that is, as we had calculated, 11,45,946. So it becomes 11 lakh 45,946. Basic EPS becomes 2.62. Firstly, we will calculate the reporting basic EPS for the financial year 22-23, whatever they had reported in the financial statement, that is in the previous year 22-23. That is net profit on the 22-23 is 22 lakhs divided by 10 lakhs. So 2.20 is the basic EPS reported in the financials of 22-23. But after giving the bonus component, effect of bonus issues and restated EPS, basic EPS for the financial year 22-23, the equity earning net profit before tax, net profit attributable to the equity shareholder is 22 lakhs divided by 10 lakhs is the number of shares outstanding plus bonus component 37,838 number of shares. 22 lakhs divided by 10 lakh 37,838, so it becomes 2.21. That is the basic EPS for the financial year 22-20. Because right issue is offered by the entity in the financial year 23-24. In that right issue, there is also a bonus component. That bonus component is if you are restating your previous year financials, then you have to give the bonus effect on that EPS. Now the following information is furnished by X Limited for the financial year 31st March 2020 and 31st March 2021. Net profit for the previous year before OCI means you will not consider the OCI element for calculating the EPS. You will take only the net profit before OCI. In PL, if you find the PL, then OCI component is there in India's balance sheets. That OCI component is not considered for calculating the EPS. So only the net profit for the previous year before OCI becomes 1244.67 millions. Now number of shares outstanding during the year becomes 57 crores 15 lakhs 69,440. Now face value of the share per share is rupees 2 per share, and net profit for the current year. Current year it means before OCI, that's 31st March 2021 become 3,431.24 millions. It was in millions. Now in financial year 2021, that is on 20th October 2020, the entity issue rights shares in the ratio of 8 shares for every 85 shares held. Means 85 shares existing shareholder will get a right issue of 8 shares. So whoever are the existing shareholders, 85 shares, they will get 8 right shares. And the issue price of the right shares is rupees 65 per share. So the face value is given 2 per share and 65 is the issue price of that share. So differential is the premium. The company opened to issue right shares on 29th September 2020. On that date, the market price of the share is 81.85. On the date when the company opened the offer of right issue to the existing shareholders, that is on 29 September 2020, the market price of the share is 81.85. Now there are some market price on different dates. That is on opening date, that is on 29th September, that is when the company opened the right issue, the market price of the share becomes 81.85. The closing date means last date to exercise the right is 13th October 2020, and that date the price is 76.20. Allotment date, the date on which the right issue is allotted, that is on 20th October 2020. On that date the price of the share is 75.35. Record date means the record date for the right issue is the date announced by the company to determine the shareholder who are eligible to receive the right entitlement. So record date for the right issue is the date the company announced the date for the issue of right shares to determine the shareholder who are eligible to receive the right entitlement. Means the existing shareholder who are eligible to receive the right entitlement, that date when the company announced for the issuance of right shares, that date is the record date. Record date for the right issue is the cutoff date as on which a company take out a list of the existing shareholders holding the stock of the company to determine the eligible shareholder for the right issues. The right issue record date is announced well in advance by the company through the letter of offer. Only the shareholder who are on record of the company as on the record date will be eligible for the right entitlement of the company to apply the right shares. Record date is on 23rd September 2020, that is the market price on that date becomes 79, and date prior to record date, that is on 22nd September 2020, it becomes 78.30. In case of right issue, we will consider the date prior to the last date to exercise the right, that is the last date, the closing date is given, the last date to exercise the right is 30th October 2022. That date price considered for determining the X right price. Now the calculation of basic EPS. The basic EPS for the financial year previous year, that is on 1920. Calculation of basic EPS for the financial year 1920, that is net profit for the previous year divided by weighted average number of equity shareholders. In this case, the net profit is given in the question, that is 1244.67 million divided by number of shares outstanding, that is 57 crores 15 lakhs 69,414. So in this case we will divide 1244.67 millions divided by 57 crores 15 lakhs 16,404, that is the number of shares outstanding during the financial year 1920. So the basic EPS is 2.18 per share. That is the basic EPS. The entity issue a right shares in the financial year 2021, that is in the next year, that is on 20th October 2020. In that date they issue shares in the ratio 8 shares for every 85 shares held. Now calculation of right issue by the entity for the financial year 2021. Number of existing shareholders, how many shareholders are there? 57 crores 15 lakhs 69,414, and they will get 85 for every 85 shares they will get 8 shares. So number of right shares issued on 20th October 2020, that is 8 shares for every 85 shares. So in that case 57 crores 15 lakhs 69,414 divided by 85 into 8. So right issue becomes 5 crores 37 lakhs 94,768. So total number of shares outstanding, closing number of shares outstanding during the financial year 2021 becomes, opening shares are 57 crores 15 lakhs 69,414 plus number of shares issued as right shares becomes 5 crore 37 lakhs 94,768. So it becomes, the closing number of shares outstanding becomes 62 crores 53 lakhs 64,182. These are the total number of shares outstanding during the financial year 2021 after the right entitlement. Now the journal entry in case of right issues. The entity had issued right shares and collected money from the investor. Bank account debit to equity share capital in the form of equity share capital, because the face value of the share becomes 2 rupees. Now the security remaining balance is the security premium. So right issue becomes 5 crore 37 lakhs 94,768 into 2. That is the equity share capital in the form of equity share capital. Balancing amount they collected as a security premium. Crore 37 lakhs 94,768 into 63, because the price at which the entity offer the right shares is rupees 65. 2 rupees is credited in the account of equity share capital, and remaining amount is credited as security premium. It becomes 338 crores 90 lakh 70,407. That is the security premium, and equity share capital becomes 10 crores 75 lakhs 89,537. So total becomes 349 crores 66 lakhs 59,944. This is the journal entry in case of right issue. We will find out the theoretical X right fair value or price excluding the right. So right issue is an issuance of shares offered by the entity to the existing shareholder at a discounted price. So theoretical X right fair value, that is the price excluding the right. So 85 shares on that date when the right is exercised. That is the closing date to last date to exercise is on 13th October 2020, because issue right shares in the ratio on 20th October 2020 and last date to exercise is 13th October 2020. That is the market price on that date is 76.20. Now for the 85 shares, the fair value before exercising of right is 76.20, plus they get the exercise right shares. Every 85 shares they will get 8 shares at a price of rupees 65. So 85 into 76.20, that is prior to the date of exercise in the right, plus 8 shares into 65. 65 is the offer price they offer for the right shares. So 85 into 76.20 plus 8 into 65 divided by 85 plus 8. That is total number becomes 93 number of shares. So theoretical right fair value, that is the price excluding the right, is 75.24 per share. Now the right adjustment factor we have to find out. Fair value before the closing date, the price on the last date to exercise the right is on 13th October, whatever the price, market price is there, divided by theoretical X right price. So it becomes 76.20 divided by theoretical X right price, that is 75.24. So right adjustment factor becomes 1.01281. This is the right adjustment factor. Now, how much proceeds from right issues? 349 crore 66 lakhs 59,944 is the proceed an entity get by issuing the right shares. Now the X right price is X right price, as we had find out, that is the theoretical X right fair value is 75.24. Now number of right shares issued at fair value. How much shares they had issued at fair value? 349 crore 66 lakh 59,944, and the theoretical X right price is 75.24. So the number of right shares issued at fair value becomes 349 66 59 944 divided by 75.24. So it becomes 4 crores 64 lakhs 73,417 number of right shares issued at fair value. These number of right shares are issued at fair value. Fair value 4 crores 64 lakhs 73,417. but actually issued by the entity. The number of shares actually issued by the entity, as we had calculated, that is 5 crores 37 lakh 94,768. This is the actual number of shares issued by the entity, but as per the fair value, the number of right shares issued is 4 crores 64 lakh 73,417. Actually issued by the entity is 5 crores 37 lakh 94,768. So in that case, the bonus component in that number of shares are number of shares issued as bonus element is the differential amount. That differential number of shares 5 crore 37 lakh 94,768 minus the number of right shares issued at fair value is 4 crores 64 lakh 73,417. So the differential becomes the bonus element, that is 73 lakhs 21,351. That is the bonus element on the number of shares issued by the entity along with the right shares. Firstly, we will calculate the current year EPS. Then we will restate the previous year EPS also. So calculation of weighted average number of equity shares, that is from 1st April to 19th October 2020, that is before the right issue, that is number of days becomes 202. Adjustment factor, that is the right issues adjustment factor. Number of shares outstanding, opening number of shares before right issue outstanding, that is as we had calculated here as given in the question, 57 crores 15 lakh 69,414. So weighted average number of shares becomes 57 crores 15 lakh 69,414 into right adjustment factor. Shares are issued to the existing shareholder only, so it will be applicable to the existing shareholders. So these adjustment factor is multiplied with the opening outstanding number of shares before the right issue. So 1.01281 number of days from 1st April to 19th October, it becomes 202 days. 202 divided by 365, so it becomes weighted average number of equity shareholders 32 crores 3 lakh 72,674. Now from after the issue, that is on 20th October 2020, the entity is entitled for right issue from that date to 31st March 2021, that is the number of days becomes 163. Adjustment factor is nil because on that no adjustment factor is applied. Number of shares as we had calculated here in note, number of shares opening plus number of right issues, total number of shares is 62 crores 53 lakh 64,182 into 163 divided by 365, so it becomes 27 crores 92 lakhs 72,224. So total number of weighted average number of equity shareholders are 32 crores 3 lakhs 72,674 plus 27 crores 92 lakhs 72,224. So total weighted average number of shares outstanding during the period becomes 59 crores 26 lakh 44,898. So these are the number of weighted average number of equity shares outstanding during the financial year 2021. Now we will calculate the EPS, net profit attributable to the equity shareholder for the financial year as given in the question. 3,431.24 million divided by weighted average number of equity share outstanding, that just now we had calculated, that is 59 crores 96 lakhs 44,898. So basic EPS becomes 5.72. Now we will restate because in the final we have to prepare the comparative figure also. So we will restate our previous year basic EPS also. So restated EPS for the financial year 1920 because we will not give the effect of right issue, but we will give the effect of bonus component in the previous year financials. So in net profit for the previous year that is 1244.67 millions divided by the outstanding number of shares, that is 57 crores 15,69,414 plus the bonus component which we had find out while calculating our right shares. Actual number of shares issued by the entity and number of right shares issued at fair value. So the differential is the bonus component, that is 73 lakhs 21,351. So we will add that with the in order to restate. So it total becomes 57 crores 88 lakhs 90,765. So we will divide the previous year net profit with the outstanding balance plus the bonus component. So restated APS becomes 2.15. In this way we will restate our previous year financials also if the bonus component is there in the current. These are the two important examples related to the right issue, as we have discussed the right issue in elaborate manner. Now we are discussing about the cumulative and non-cumulative, the concept related to cumulative preferentials and non-cumulative preferentials. What are the in the AS regime? What we do, we will take the net profit after tax and we will reduce the preference dividend. Then the net profit attributable to the equity shareholder we will calculate for finding the EPS in the AS regime. But in the Ind AS regime, the calculation is something different for cumulative and non-cumulative preferentials. So the calculation of EP different in certain cases from AS regime. So what difference are there? We will discuss today in Ind AS. Ind AS, what says cumulative preferentials? What is, firstly we will understand what is cumulative. Cumulative means deduct every year declared or not. Means if you declare or not, it is not mandatory to declare the dividend in case of cumulative, but you have to deduct every year the cumulative whether you are declared or not. But in case of non-cumulative, you have to deduct only if you have declared in the reporting period. If you had not declared, you don't need to pay the dividend in case of non-cumulative preferentials. But in case of cumulative preferential, it is mandatory to pay dividend even you are not declared. So cumulative preferentials are regular preferentials with one additional benefit. The extra advantage here is that the holder of these shares have the right to receive dividend even if the issuing company has missed out on paying them in the past. If in any single year the company missed out to pay the dividend to their shareholders, preference shareholders, the preference shareholders is having right to receive the dividend even if the entity is not paying or not declaring the dividend in due to cash crunch. But in case of non-cumulative preference shares are those shares that provides the holder a fixed dividend amount each year from the company's net profits. So non-cumulative preference shares are those shareholders, they will get a fixed dividend amount each year from the company's net profit. If the company fails to pay the dividend on such preference shares to the shareholder in any year due to cash crunch, then such dividend cannot be claimed by the shareholder in the future. Means in cumulative, if the company missed out to pay dividend, the shareholder has the right to receive the dividend in future. But in case of non-cumulative, the shareholder has no right to receive the dividend if the company missed to pay the dividend to the shareholder. If the company is having the profit, they will declare the dividend. If the company is not having the profit, they will not declare the dividend. So in case non-cumulative preference share, if the company fails to pay the dividend, in such case also the shareholder is not having the right to claim the dividend in future in case of non-cumulative. But in case of cumulative, they have the right to claim the dividend if the company missed to pay dividend in any regime. In India's regime, what there is the features of preference share that as per the company law, preference share capital shareholders has to be paid before the equity shareholder in case of liquidation. So, as per Companies Act also, the preference share capital should be mandatory redeemable. It will be redeemable after a period of 15 years or 20 years as per the Companies Act, and maximum tenure the company should carry out for a period of 20 years. Maximum period the company should carry out the preference share capital in its books is for a period of 20 years. After that, the entity should redeem that preference share capital. In case of preference shares, fixed rate of dividend is paid by the company to its shareholders. So there is a fixed rate of dividend given to the shareholders in case of preference share. So preference share is not treated as a capital, it is treated as a liability. If there is an obligation to pay cash, there are two types of preference shares in Ind AS regime. In case of Ind AS, in case if there is a liability to pay cash in the form of dividend, in the form of redemption of preference shares in cash, then that is obligation to deliver cash. In that case, that preference shares is to be treated as a financial liability, and the preference dividend is treated as a finance cost. That finance cost, if you in PL you already debit that finance cost, it will be treated as a liability already considered in the net profit after tax. So no further adjustment required for preference dividend. In case of preference dividend, which is redeemable, and which is there is a obligation to deliver cash, and which is already considered in the net profit after tax, so no further adjustment for that preference shares is required for reducing the dividend, preference dividend. But in case of irredeemable means it will not redeem in future, it will convert into equity. The nature of that preference shares is not redeemable, it will not redeem in future, and the dividend is discretionary, it is depend on the management decision, it is not compulsory to pay dividend. In that case, it is a nature of equity, there is no obligation to deliver cash. So if there is no obligation to deliver cash, then it is a financial instrument in the form of equity. That preference dividend is not a finance cost, hence not considered in net profit after tax. Hence deduct preference dividend from the net profit after tax to arrive at net profit attributable to equity. Now we will discuss about the concept related to premium paid on early redemption or conversion of preference shares. Means if any premium is paid on early redemption, this concept is explained with the help of example. Suppose you had taken a home loan for a period of 25 years from a bank, HDFC Bank. Home loan amount is to rupees 2 crores, out of which you had made a payment of 50 lakhs, a down payment, and 1.5 crores is the amount of loan which is paid in installment over 25 years. The EMI amount will be 2 lakhs per month. Now, what happened? Because of your promotion or done an excellent job, or you get a job in MNC, and your package is quite high, and you also got a promotion, you pay the home loan earlier. Earlier than the contractual period of 25 years, you pay a home loan within 4 years, you pay amount. So even you had paid earlier that loan, you have to pay certain penalty to the bank because you had made a prepayment of the loan amount. Due to that, there is a loss of bank interest of 21 years because the contract is for 25 years. You repay the loan within 4 years. There is a loss of interest to the bank for 21 years, which they will get when you pay an EMI for a period of 5 years. So in case of prepayment, even you are paying earlier than the contractual period, you have to pay certain penalty. The bank levy certain penalty on early payment of the loan amount. That penalty is due to the loss of interest which the bank will incur if you pay early than the contractual. But in case of preference shares, what happened? Premium paid on early redemption or conversion of preference shares. Example we are taken to understand what is the early redemption. Preference shares classified as equity. If the preference shares are classified equity, premium paid generally taken to the security premium or retained earning, whether converted or redeemed. Implication for EPS: deduct from the net profit to arrive at net profit attributable to equity shareholder. As such, premium is not deducted while calculating the net profit after. The preference share classified as liability. Usually the premium paid, regardless of conversion or redemption, will always be taken to PL regarded as finance cost. So, if any premium amount is paid, if the preference share is considered as a liability, then that premium is treated as a finance cost and it should be debited to PL account, and no adjustment is required if the EPS is calculated because it is already deducted from the net profit after tax. While computing the net profit after tax, it is already deducted as finance cost. So no further deduction is required. If the preference shares are considered as equity and if any premium paid which will be taken to the security premium or retained earning, whether the preference shares are converted or redeemed. What was the implication? Because it is not deducted from the net profit to net profit after tax, so it is further deducted from net profit to arrive at net profit attributable to equity shareholder. As such, premium is not deducted while calculating the net profit after. Now, treatment of certain items in computation of basic numerator. In case of early conversion, means early conversion of preference shares may be induced by an entity through favorable changes to the original conversion terms or payment of additional consideration. As we had discussed the example of SDFC, that in case of early prepayment of loan amount, there is a certain penalty is levied by the bank person who has taken. Case of early conversion of preference shares may be induced by an entity. Early conversion of preference shares done by an entity in favorable changes to the original conversion terms or payment of additional consideration. Excess of fair value of consideration of ordinary shares or other consideration paid over the fair value of the ordinary shares issuable under the original conversion terms is a return to the preference shareholder. That excess amount the entity pay if the entity itself convert the early conversion of preference shares, take a step to convert the preference shares before the period prescribed in the original contract, then in that case an entity has to pay an excess amount to the investors. So that excess of the fair value of consideration of the ordinary shares or other consideration paid over the fair value of ordinary shares issuable under the original conversion terms, under the original contract, whatever they pay excess of the due to early conversion. That excess amount is the return to the preference shareholders. That excess amount is treated as a return to the preference shareholder and treatment of that is this amount is deducted in calculating the profit or loss attributable to ordinary equity holder of the parent. So this amount in the hand of the entity, this is to be deducted as cost while calculating the net profit attributable to the equity shareholder. Carrying amount is if the carrying amount is greater than fair value for the settlement, excess of carrying amount of preference shares over the fair value of the consideration paid to settle them is added in calculating profit or loss attributable to equity holder of the parent. Now, this concept of early payment, early redemption of preference shares is explained with the help of example. Suppose an entity has following preference shares in issue at the end of 2024. 5% redeemable non-cumulative preference shares. There are 5% that is redeemable, that will redeem within a period, non-cumulative on which dividend is not cumulative in nature, means it is a discretionary. If the dividend is paid upon the discretion of the management, that is the 5% redeemable non-cumulative preference shares. These shares are classified as liability. Obviously, these shares are classified because there is an obligation to pay cash because it is a redeemable in nature. During the year, a dividend was paid on the 5% preference shares of rupees 1 lakh. So it is non-cumulative. The dividend is declared by the entity and it should be paid. If the entity will not declare, they will not pay. In this case, they are declared a dividend and it should be paid on 5% preference shares of rupees 1 lakh. Dividend is to be. Now increasing rate, cumulative. Cumulative means on which even the entity will not declare, the investor or the shareholder were entitled to receive the dividend. Cumulative non-redeemable. It will not redeem, so that is the kind of equity in nature. Non-redeemable preference share issued at a discount in 2020 with a cumulative dividend rate from 2025 of 10%. The shares were issued at a discount to compensate the holder because dividend payment will not commences until 2025. The accrual for the discount in the current year, calculated using the effective interest method, amounted to say rupees 18,000. These shares are classified as equity amounting rupees. Now 8% non-redeemable non-cumulative preference shares. 8% non-redeemable which will be converted into equity. It will not redeem. And non-cumulative preference shares means dividend is declared or paid at the discretion of management. It is not a compulsory dividend payout. So at the beginning of the year, the entity had rupees 1 lakh 8% preference shares outstanding. But at 30 June 2024, it repurchased rupees 50,000 of these at a discount of rupees 1,000. So it repurchased rupees 50,000 of these at a discount of rupees 1,000, that is rupees 50,000. Now 7% cumulative convertible preference share that will be converted into equity, and dividend is also paid. Even it was not declared, it will be paid. These shares were classified as equity until their conversion into ordinary shares at the beginning of the year. No dividend was accrued in respect of the year, although the previous year dividend was paid immediately prior to the conversion. To induce conversion, the terms of conversion of the 7% convertible preference shares were also amended, and the revised term entitled the preference shareholder to an additional 100 ordinary shares on conversion with a fair value of rupees 300 is nil. The profit after tax for the year 2024 is 1,50,000. Determine the adjustment for the purpose of calculating the EPS. Now what adjustment we will do while calculating the EPS? Adjustment for the purpose of calculating EPS are made as follows. Profit after tax as given in the question, that is profit after tax for the year 2024 is 1,50,000. Now amortization of discount on issue of increasing rate preference shares, that the discount is amortized. The accrual for the discount in the year calculated using the effective method amounting to say rupees 18,000. So this discount due amortized of discount on issue of increasing rate preference shares. Now discount on repurchase of 8% preference shares is also given. 8% non-redeemable preference shares at the beginning the entity has 1 lakh 8% preference share outstanding, but at 30 June it repurchased 50,000 of these at a discount of rupees 1,000. So discount on repurchase of 8% is 1,000, which should be added. Premium to induce conversion. So in this case, to induce conversion, the terms of conversion of 7% convertible preference shares were also amended, and revised terms entitled to the preference shares holder to an additional 100 ordinary shares on conversion with a fair value of rupees 300. So 100 into 300, it becomes 30,000. So 30,000 is the premium to induce conversion. It should be reduced from the profit. Discount is to be added. Amortization of discount is an expense which is not included in the profit after tax, so it should be reduced. Discount on repurchase is an income which is also not added in the profit, so it should be added. And premium to induce conversion into equity, some premium amount is paid, that is a cost to the entity, so that cost is not debited to arrive at net profit. So it was now for calculating the net profit attributable to the equity shareholder for calculating EPS. Now it should be reduced. Now total becomes 30 plus 18, it becomes 48 minus 1, that is 47,000. So profit attributable to the ordinary equity holder for calculating the basic EPS is 1,50,000 minus 47,000, it becomes 1,03,000. So this is the calculation which is done after arriving at a profit after tax. That expenses or that income is not included before, so it should be debited or credited out from the profit after tax to arrive at the profit attributable to the ordinary shareholder in order to calculate the EPS. ABC Limited issued 9% preference shares of fair value of rupees 10 each on 1st April 2021. Total value of the issue is rupees 10 lakh. The shares are issued for a period of 5 years and would be redeemed at the end of 5th year. So it's a redeemable preference shares which would be redeemed at the end of 5th year. The shares are to be redeemed at rupees 11 each. So preference shares, 9% preference shares are redeemed at rupees 11 each, because the fair value of the shares is rupees 10 each and it should be redeemed at rupees 11 each. At the end of year 3, that is on 31st March 2024, the company finds that it has earned good return that expects over the last 3 years and can make the redemption of preference share early. So company had earned a good return in their profits, so they expected to return or redeem the preference share before the maturity. That is, the maturity period is 5 years, but they redeem within a period of 3 years. They decided to redeem because of the good return they expect over 3 years, last 3 years, they want to redeem the preference share early. To compensate the shareholder for 2 years of the dividend which they need to forego, the company decided to redeem the shares at, because the company has redeemed the preference shareholder before the maturity, that is the early redemption. In case of early redemption, what happened? Loss of shareholders, the loss of dividend to the shareholders for 2 years, because they had the contractual period is 5 years and they redeemed the share early, that is within 3 years. So there is a loss to the shareholder, the dividend income. So company want to compensate that dividend income by paying to the shareholders rupees 12 each preference shareholders against the original agreement of rupees 11. Comment on the impact of early conversion of preference shares at a premium on earning for the year 23-24 attributable to the ordinary equity holder of ABC Limited for basic EPS. Ignore the applicability of standards on the financial instruments. Ignore effective interest rate. Further additional payment to be made can be made from securities premium reserve as premium on redemption and answer on the basis of Ind AS 33. Solution: in the given solution, rupees 1 per share is the excess payment made by the company amounting to rupees 1 lakh. The preference total value of the issue is 10 lakhs and fair value of the share is 10 each. So number of shareholders are 1 lakh and excess premium is paid. That is the amount which is paid in excess of the actual original agreement. That is the original agreement, it should be paid 11, but due to early redemption they paid to the shareholder rupees 12. So excess amount they paid to the shareholder is rupees 1, that is 12 minus 11, 1 rupees per share in excess payment made by the company amounting to in total shares 1 lakh into 1, that is 1 lakh in all. The amount of rupees 1 lakh will be deducted from the earning of the year 23-24 while calculating the basic EPS of the year 23-24. So that excess amount, that early payment made by the entity is to be deducted from the net profit after tax in order to derive the net profit attributable to the equity shareholder for calculating the basic EPS for the year 23-24. Now we will discuss about the concept related to participating preference shares. Appendix to Ind AS 33. This concept is explained with the help of example. Suppose an entity has two classes of shares issued, that is 5,000 non-convertible preference shares, that is not converted to equity. They will redeem after a period, after 15 years or 20 years. There is a period of redemption. So they are not converted into equity. 5,000 number of shares are there and 10,000 ordinary equity shares are there. The preference shares are entitled to a fixed dividend of rupees 5 per share before any dividend are paid on the ordinary shares. So preference shares are entitled to get the dividend of rupees 5 per share because it's a liability they had to pay before any dividend paid to the equity shareholder. Ordinary dividend are then paid in which the preference shareholder do not participate. Each preference shares then participates in any additional ordinary dividend above rupees 2 at a rate of rupees 50% of any additional dividend payable on an ordinary shares. So entity profit for the year is 1 lakh and dividend of rupees 2 per share are declared on the ordinary shares. Compute the allocation of earning for the purpose of calculation of basic EPS when an entity has ordinary shares and participating equity instruments that are not convertible into ordinary shares. Participating in equity instruments which are not converted into equity. The solution is profit before dividend as given in the question, that is entity's profit for the year is 1 lakh, that is before dividend. There's the preference share dividend is 5,000 number of shares and dividend paid to the preference shareholder is 5. So it becomes 25,000 which is to be reduced. Then the dividend paid to the equity shareholder, that is how many number of shares, that is 10,000 ordinary equity shareholder. They had to for that the dividend of rupees 2 per share is to be declared on the ordinary shareholders and paid. So less equity dividend, that is 2 into 10,000, 20,000. The remaining amount, that is 1 lakh minus 25 minus 20,000, it becomes undistributed profit becomes 55,000. That is the undistributed profit That profit is not distributed to any equity holder. Let the shares of dividend for each ordinary shares be X is the undistributed profit, which is assuming that notionally distributed to the number of ordinary X number of ordinary shareholders. Therefore, allocation to each preference shareholders is 50% of that, 50% into X. Therefore, 10,000 number of shareholders, 10,000 X plus 5,000 plus 0.5X equals to 55,000. So X is 4.40. Now distributed equity share is rupees 2 and preference share is 5. Undistributed equity share is 4.40 and preference share half of that, that is 2.20. Basic EPS is 2 plus distributed plus undistributed. Means that undistributed profit is to be divided in the 50-50 ratio. Now 10,000 in are the number of shareholders. They will get the X number of dividend plus 5,000 number of shareholders. They will get 50% of X dividend, which is equals to 55,000. So if we equate that, X is 4.40. That is the number of equity shareholder will get the dividend, and the preference shareholder will get half of that, that is 50% of that, that is 2.20. So distributed plus undistributed, distributed becomes 2, undistributed becomes 4.40 in case of equity share. So total basic EPS is 6.40. Preference share is distributed is 5, undistributed is 2.20. So basic EPS is 7.20. Number of shares is, in case of equity, 10,000 and in case of preference share 5,000. So 10,000 into 6.4, so it becomes 64,000. And 5,000 into 7.20, so it becomes 38,000. Now if we will equate both the number of dividend paid, amount of dividend paid, the total become 1 lakh. So 64,000 plus 36 is become 1 lakh. That 1 lakh is profit before dividend, which is to be distributed between the equity shareholder and preference shareholder. This is the concept of participating preference share. Now what was the sequence we will discuss for calculating the EPS in case of participating preference shares? Firstly, you will calculate the undistributed profit, that is net profit minus preference dividend distributed minus equity dividend distributed. Find allocation per equity share and per preference share if all undistributed profit were to be distributed. Generally, allocation per equity share is taken as X. Based on sharing ratio, allocation to preference share is to be computed. Formulate the linear equation, that is total undistributed profit equals to number of equity share into allocation per equity share plus number of preference share into allocation per preference share. This is the linear equation to calculate the allocation of to the equity shareholders and preference shareholders. Now EPS would needs to be separately calculated for the equity share as well as participating preference share. Therefore, EPS becomes distributed dividend per share plus share in undistributed profit. EPS would needs to be separately calculated for equity share as well as participating preference shares. So therefore, EPS equals to distributed dividend per share. How much the dividend is distributed per share plus share in undistributed profits. In this way, distributed and undistributed profits of both the preference shares and equity is to be calculated. Now measurement of diluted EPS. Now we will discuss about the concept which is related to the diluted EPS. How diluted EPS is calculated, what is the meaning of dilution, what is the meaning of anti-dilution. Dilution means if there is a continuous reduction in the EPS an increase in loss per share, then it is to be treated as a dilution. I mean, after dilution, if there is an increase in EPS, then that is to be treated as anti-dilution. A reduction in loss per share. If there is a reduction in loss per share, then that is to be an anti-dilution. If there is an increase in loss per share, then that is to be treated as a dilution. Meaning of dilution and anti-dilution. Dilution reportable means reduction in EPS. If there is a reduction, continuous reduction in EPS, then it is a diluted EPS. And if there is a loss there is an increase in loss per share, then it becomes a diluted EPS. What is anti-dilution? If there is an increase in EPS, then it becomes an anti-dilution. Reduction in loss per share, then it becomes an anti-dilution. These we will explain with the help of example, then we will going to understand. Resulting from the assumption that convertible instruments are converted, or options or warrants are exercised, or ordinary shares are issued upon the satisfaction of specified condition. Potential ordinary shares means that will be converted into equity. That ordinary shares that have a potential to convert in equity. Financial instruments or other contract that may entitle its holders to the ordinary shares. For example, convertible preference shares have a potential to convert into equity, or potential convertible debenture having a potential to convert into equity. Options and warrants, contingently issued shares. So these are the shares that have a potential to convert into equity, and if they are converted into equity, then in that case the excess, the additional number of shares which increase an additional earning is to be calculated, which is to be called as diluted EPS. Computation of diluted EPS. How we will compute the diluted EPS? Diluted EPS is computed by adjusting the net profit or loss for the period attributable to the equity holder, divided by adjusted weighted average number of equity share outstanding during the period. Now, what is adjusted net profit? Adjusted net profit means the profit which is net profit after tax plus any adjustment related to the preference dividend, if any interest is paid to the debenture holder after tax, that is the adjusted net profit. And adjusted weighted average number of equity shares means whatever the number of shares outstanding, adjusted with the preference shareholders, adjusted with convertible debenture holders, which is converted into equity, the option which is converted into equity. That way we will calculate the diluted EPS. Component of diluted EPS. What are the component? General situation, the profit or loss attributable to the ordinary equity holder of the parent entity, and if there is a profit or loss from discontinuing operation as per Ind AS 33, profit or loss attributable to ordinary equity holder of the parent entity, that is from continuing and discontinuing operation, and profit or loss from continuing operation attributable to those equity holders. So these are the components. Procedure for computation of diluted EPS. What are the procedures for computation of diluted EPS? Determine dilutive potential ordinary shares. Firstly, you will determine the dilutive potential ordinary shares which have a potential to convert into equity, that is the convertible debenture, options, etc. Firstly, we will find out that, then compute adjusted profit or loss for the period attributable to ordinary equity holder of the parent entity, compute the adjusted weighted average number of equity shares outstanding during the period, then compute basic EPS and diluted EPS based on pre-adjusted and post-adjusted figures. In this way we will calculate. We will explain this procedure with the help of example how we will calculate the diluted EPS. Suppose Darbhanga Limited gives you the following information. Compute diluted EPS. Net profit for the year is given 200 lakhs. Number of equity share outstanding 40 lakhs. Basic EPS is 200 lakhs divided by 40 lakhs. It becomes rupees 5 per share. Number of 11% convertible debenture of rupees 100 each. Each debenture is converted to 8 equity shares. So there is 50,000 convertible debenture. The value of that debenture is 100 each. Get an interest of 11%, and that debenture is convertible into equity. Each debenture is getting a number of 8 equity shares. So the interest expenses for the current year is 5,50,000. How it becomes? 50,000 into 100 into 11%. So the interest for the current year is 5,50,000. Tax saving related to interest expenses. So it becomes 1,65,000. Percentage is not given directly. The tax amount is given. Now we will calculate the diluted EPS with the help of this. Profit or loss attributable to the equity holder for basic EPS given in the question, that is 200 lakhs. Weighted average number of shares is also given 40 lakhs, and basic EPS is 200 lakhs divided by 40 lakhs. It becomes rupees 5 per share. Now we will adjust the dilution effect on that. That is adjustment for dilution is 5,50,000 is the interest on convertible debenture, which is the incremental earning, minus the tax on that 1,65,000. So the incremental earning becomes 3,85,000. That is the adjustment for the dilution, 3,85,000. Profit or loss attributable to equity holder is 200 lakhs plus 3,85,000. So it becomes 2 crore 3,85,000. Now owners become how to calculate weighted average, because the 50,000 debenture holder will convert it into equity. One debenture holder will get 8 equity shares. So 50,000 into 8 divided by 1. So it becomes 4 lakh. Now the dilution adjusted EPS, diluted EPS becomes 2 crore plus 3,85,000. It becomes 2 crore 3,85,000. And weighted average number of shares becomes 40 lakhs plus 4 lakhs, that is 44 lakhs. Now the diluted EPS is 2 crore 3 lakh 85,000 divided by 44 lakhs. So 4.63 is the diluted EPS. So in these way means we will give the effect of the convertible, the potentially convertible debentures or preference or option in order to calculate the dilution effect. Now another example is, while calculating the diluted EPS, effect is given to all diluted potential ordinary shares that were outstanding during the period. Accordingly, calculate diluted EPS from the following information. Now solution. Profit or loss attributable to the ordinary holders, that is for calculating basic EPS given in the question, 85 lakh 50,000. Weighted average number of equity shareholder given in the question is 20 lakh. So EPS is 85 lakh 50,000 divided by weighted average number of equity shareholder, that is 20 lakh. So EPS is 4.275. Now we will make the adjustment for dilution, because the number of 8% convertible debenture of rupees 100 each. Debentures are there, 1 lakh debentures are there. Each debenture is converted into 10 equity shares. So number of equity shares becomes 1 lakh into 10 divided by 1. As per the current year interest, the debenture is issued by the entity for a period of 9 months, because the interest expenses for the current year is 6 lakh. But as per the calculation, if we calculate 1 lakh into 100 into 8%, so it becomes 8 lakh. And after tax, it becomes 5,60,000. And actually the interest is given by the entity is 6 lakhs, but as per the calculation it should be 8 lakhs. Interest expenses for the year is 4,20,000 becomes after tax interest on convertible debenture. Convertible debenture which is converted into equity share is 1 lakh is the total number of debenture which is converted into equity. One debenture holder will get the 10 equity, so 10 into 10 divided by 1, because they use these shares for a period of 9 months. Time weight factor is given, that is 9 divided by 12, so 1 has becomes 7,50,000. Adjustment for dilution for weighted average number of equity is 7,50,000. 85,50,000 plus 4,20,000, it becomes 89,70,000, and 1 has 20 lakhs plus 7 lakh 50,000, so becomes 27 lakh 50,000. 89 lakh 70,000 divided by 27 lakh 50,000, it gives the diluted EPS amounting rupees 3.26. Calculate basic and diluted EPS of Meghna Limited from the following particulars. Number of equity shares, that is rupees 10 each, as at the beginning of the financial year, that is 50 lakhs. Net profit after tax for the year is 200 lakhs. Number of shares outstanding. Number of shares of rupees 10 each issued for cash on 1st July. 10 lakhs. Face value of the shares is rupees 10 each. Issued of bonus share on 1st October, that is 1:5, as at the beginning of the year, that is 10 lakh shares. Convertible debenture outstanding at the beginning of the year is 10% debenture of rupees 1 crore, that is 100 per debenture, rupees 100 per debenture. So number of debentures are 10 rupees 1 crore debenture at the value rupees 100 per share per debenture. Now conversion ratio is 10 shares for one convertible debenture. Company tax rate is 40%. Now you have to calculate the basic and diluted EPS of Meghna Limited. Now firstly you will calculate the computation of weighted average number of shares outstanding during the period. Firstly the opening number of shares are 50 lakh. Number of equity shares as at the beginning of the financial year become 50 lakh. So on 1st April the number of outstanding shares become 50 lakh. Now on 1st July, the company issue 10 lakh further shares in cash. So on 1st July, the number of shares become 10 lakhs. The company issue bonus share on 1st October. That is 1:5 as at the beginning of the year. The company issue 10 lakh shares as bonus shares. 1:5 ratio. That is, there is a 50 lakh shares on the opening balance. They had given 1:5 for every 5 shareholder. They had given 1 share. So divided by 5 into 1, it becomes 10 lakh. So deemed to be from the beginning of the year 10 lakh shares issued on 1st October. Now period outstanding for the opening balance, that is on 1st April. The period outstanding is 12 months. Time weighing factor is 12 divided by 12. It becomes 50 lakh into 12 divided by 12. It becomes weighted average number of equity share becomes 50 lakhs. Now on 1st July, the company issue further shares in cash, 10 lakh shares. So July, August, September, October, November, December, January, February, March is 9 months. Period outstanding. Time weighing factor is 9 divided by 12, so it becomes 10 lakh into 9 divided by 12, so it becomes 7 lakh 50,000. Now on 1st October, they issue a bonus on the opening balance, on the opening outstanding, 1:5 ratio. That is, every 5 shareholders will get the 1 share. So there is a 50 lakh divided by 5 into 1, so it becomes 10 lakh. It is assumed that it is issued on the beginning of the year on the existing shareholder who had period outstanding is 12 months. Time weighing factor is 12 divided by 12, so it becomes 10 lakhs. Total number of weighted average number of shares outstanding during the period for calculating the basic EPS is 67 lakh 50,000. That is 50 lakhs plus 7 lakh 50,000 plus 10 lakhs. So it becomes 67 lakh 50,000. Now we have to calculate the basic EPS. Profit after tax for the year is 2 crore. Weighted average number of equity shares is 67 lakh 50,000. So EPS is 2 crore divided by 67 50,000. So EPS is 2.96. That is the basic EPS. Now we have to give the dilution effect on that. That is dilution, adjustment for dilution for calculating the diluted EPS. Convertible debenture outstanding at the beginning of the year is 10% debenture for rupees 1 crore. So number of debentures are 1 crore divided by 100 into number of shares. The conversion ratio is 10 shares for every 1 convertible debenture. So divided by 1 into 10, so it becomes 10 lakh number of debentures. The interest on that debenture becomes, the incremental earning becomes 1 crore into 10% into, after tax it becomes 60%. 1 crore into 10% into 60%, so it becomes 6 lakh. So incremental adjustment for dilution is 6 lakhs and weighted average number of shares for dilution is 10 lakh. Now we have to calculate the adjusted EPS, that is profit attributable to the ordinary shareholder. For calculating the basic EPS given in the question is 2 crores. Adjustment for dilution, that is 6 lakhs. So 2 crores 6 lakhs is the profit attributable to the ordinary shareholder, and weighted average number of equity shareholder becomes 67 lakh 50,000 plus adjustment for dilution is 10 lakhs, so it becomes 77 lakh 50,000. EPS is 2 crore 6 lakhs divided by 77 lakh 50,000, so it becomes 2.66. This is the adjusted or diluted EPS after giving the effect of dilution. From the following information furnished, compute the basic and diluted EPS of Tamara Limited financial year 21-22 as well as adjusted EPS for the financial year 22-23. Assuming tax rate at the rate 30%. Now net profit for 21-22 is 75 lakhs 50,000. Net profit for the financial year 22-23 is 1 crore 25,000. Now number of equity shares as on 1st April 2021 becomes bonus issue on 1st January 2023 is 1 share for every 2 share held. 12% convertible debenture of rupees 100 each issued on 1st January 2023 is 1 lakh. Conversion rate of debenture is 10 shares per debenture. Now we have to calculate the weighted average number of shares outstanding during the period, because in this question the net profit of 2 years is given, that is on 21-22 and 22-23, and number of equity shares as on 1st April 2021 is given, that is 50 lakhs 250. So we have to calculate firstly the basic EPS for the financial year 21-22. So the basic EPS for that year is 75 lakh 50,000, that is net profit for the financial year 21-22 divided by the number of shares outstanding during the financial year 21, that is 50 lakhs 250. So 70 lakh 50,000 divided by 50 lakh 250, it becomes 1.51 per share. So this we had to calculate the basic EPS of the financial year 2021. Now we have to calculate the basic EPS of 2020 22-23. So there is no change in the financial year after that 21-22. In the financial year 21-22, the same outstanding number of shares is to be continued in 22 also. So on 1st April 2022, the outstanding number of shares are, in order to calculate the weighted average number of shares outstanding during the period, opening balance becomes 50 lakh 250 for a period outstanding is 12 months. Time weighing factor is 12 divided by 12, so it becomes 50 lakhs 250 becomes the weighted average number of equity shares. Now on 1st January 2023, that is on financial year 22-23, on 1st January 2023, the entity issue a bonus for every 2 share held, 1 share is to be given. So 50 lakh 250 divided by 2 into 1, it becomes 25 lakhs 125. That is the bonus component. bonus component time weighing factor is given for 12 months. So period outstanding, because the existing shareholder will get the bonus component. So time weighing factor on the bonus component is given from the beginning of the period. So it taken 12 months time weighing factor, 12 divided by 12. So weighted average number of equity shares becomes 25 lakh 125. So total weighted average number of equity share outstanding during the period for calculating the basic EPS becomes 75 lakhs 375. Particular profit or loss attributable to ordinary holder for basic EPS becomes 25,000, 1 crore 25,000 given in the question. The net profit for the financial year 22-23, that is 1 crore 25,000. 1 crore 25,000 bonus we had calculated by giving the weighting time weighing factor, that is 75 lakhs 375. So basic EPS is 1 crore 25,000 divided by 75 lakh 375, that is EPS become 1.34 per share. Now we have to give the adjustment for dilution. Dilution effect is given because the convertible debenture is 1 lakh at the rate 12%, so interest is 1 lakh into 12% for a period of 3 months. So January, February, March, 3 divided by 12 after giving the tax effect is 70%. So that is the net incremental earning. So 1 lakh into 100. 1 lakh is the number of shares, 100 is the value, face value, into 12% is the interest. 2023, so for a period of 3 months, 3 divided by 12, but after tax giving effect, that is tax rate is 30%, so it becomes 70%. So 12 lakh into 70% becomes 2 lakh 10,000. So incremental earning is from debentures is 2 lakh 10,000. Now the number of shares, that is every share, every debenture holder will get, every one debenture holder will get 10 shares. So number of shares are 10 lakh. Time weighing factor is also given. So 3 divided by 12, so it becomes 2 lakh 50,000. 1 lakh into 10 divided by 1 into 3 divided by 12, so it becomes 2 lakh 50,000. So adjustment for dilution 2 lakh 50,000. Now profit attributable to the ordinary equity shareholder after giving the dilution effect, that is 1 crore 25,000 plus 2 lakh 10,000, it becomes 1 crore 2 lakh 35,000. And weighted average number of shares after giving the dilution effect becomes 75 lakh 375 plus 2 lakh 50,000, it becomes 77 lakh 50,000 375. Adjusted EPS becomes 1 crore 2 lakh 35,000 divided by 77 lakh 50,000 375, it becomes 2.66. 2.66 is the diluted EPS and 1.34 is the basic EPS. From the following information of Chandrakala Limited, determine the order in which the diluted potential equity share should be considered in the computation of diluted EPS. Means the potential equity share are those diluted number of shares, that is debentures, that have a potential to convert into equity, that is convertible preference share that have a potential to convert into equity, options that have a potential to convert into equity. That kind of potential equity shares is given in calculating the diluted EPS. So firstly, net profit attributable to the equity holder for calculating the basic EPS is 1 crore 50 lakhs. Number of equity share outstanding during the period is 25 lakhs. Average fair value of one equity share. Fair value of the share is given is rupees 100. Now details of potential equity share also given in order to calculate the diluted EPS. Options is given 1,20,000 shares with an exercise price of rupees 75 per share. In this, exercise price is given and fair value is also given. Convertible preference share is 10 lakh shares entitled to a cumulative dividend of rupees 8 per share. Conversion ratio is 4 equity share for every preference share held. For every one preference shareholder, they will get the 4 equity shares. And the interest component in this is 10 lakh shares will get the dividend of rupees 8 per share. 15% convertible debenture of 10 each is also 12 lakh each debenture is entitled for 2 equity shares. Number of share debenture is 12 lakhs and they are entitled for a 2 equity share. Assumed corporate income tax rate is also given, that is 30%, and dividend distribution tax rate is also given, that is 10%. Now we have to calculate the dilute. Now solution: computation of additional earning per incremental shares of determining the ranking. The basic EPS 1 crore 50 lakhs divided by 25 lakhs, so it becomes rupees 6 per share. Rupees 1 crore 50 lakhs divided by 25 lakhs, so basic EPS becomes rupees 6 per share. That is the basic EPS. Now we will give the adjustment for dilution. So we will compute the additional earning per incremental share. So in case of option, there is option given 1,20,000 shares with an exercise price of 75 per share. So for option, there is an exercise price of 75, but the fair value is given, that is 100 rupees. One equity share, the fair value is 100 rupees. So we have to determine the number of options exercised. So number of option exercised is 1,20,000 is given into the fair value is 100, exercise price is 75, the minus 75 divided by fair value, that is 100. So it becomes 1,20,000 into 25 divided by 100. So 30,000 number of shares is to be exercised in case of option. So 30,000 additional net profit after adjusting tax expenses. There is no additional income. Profit is there in case of option, but additional number of equity share included in diluted EPS is 30,000 as we had calculated here. Now in case of convertible preference shares, what given in the question, convertible preference shares, that is 10 lakh shares entitled to a cumulative dividend of rupees 8 per share, and dividend distribution tax rate is also given 10%. General tax rate is also given 30%, and conversion ratio is 4 equity shares for every 1 share held. One preference shareholder will get 4 equity shares. Now tax adjustment: adjusted interest on convertible preference shares, that is dividend for the year 10 lakh number of shares into 8 plus the dividend distribution tax, that is on 80 lakhs 10%, it becomes 88 lakhs. As incremental earning, convertible preference shares in increment 88 lakhs, and adjusted for dilution, that is number of shares 10 lakh preference shares are there. Every one preference shareholder will get 4 equity shares, so 40 lakh number of shares. The additional number of equity shares included in diluted EPS in case of convertible preference shares is 40 lakhs. Now we will find the 15% convertible debenture of 100 each. 12 lakh each debenture is entitled for 2 equity shares. So number of shares will becomes 24 lakhs because each debenture holder will get 2 equity share. So number of shares becomes 12 lakh into 2 divided by 1, so it becomes 24 lakh. So 24 lakhs in case of convertible debenture the equity shareholder will get, and the interest component is 12 lakh into 100 into 15%, that is 12 lakh into 100 into 15% into, that is 70% after tax, so it becomes 1 crore 26 lakhs. So 1 crore 26 lakhs is the incremental earning in case of convertible debenture. The earning per incremental share, in case of option there is nil because no incremental profits is there. In case of convertible preference share, 88 lakhs divided by 40 lakhs, so it becomes 2.20. In case of convertible debenture, 1 crore 26 lakh divided by 24 lakhs, so it becomes 5.25. That is the incremental earning per share. But we have to find out the diluted EPS. So net profit given in the question is 1 crore 50 lakhs. That is number of equity outstanding is 25 lakhs. Earning per share is 1 crore 50 lakh divided by 25 lakh. 6 per share, that is the basic EPS. Now adjustment for option, the profit attributable to the option is nil. Number of outstanding shares in case of increment or adjustment for option is 30,000. Earning per share becomes 1 crore 50 lakh plus adjustment for option is nil. So 1 crore 50 lakhs divided by 25 lakhs plus 30,000. So it becomes 25 lakh 30,000. So earning diluted EPS becomes 5.93. Now these diluted EPS are in decreasing pattern. They are in the decreasing pattern. So from 6 they becomes, after giving the option adjustment, they become 5.93. So they, if they are in decreasing pattern, then they are a diluted EPS. Now we have to give the adjustment for preference shares. Incremental earning is 88 lakhs and incremental number of shares is 40 lakhs in case of preference shares, as we had calculated. Now total 1 crore 50 lakhs plus adjustment for option nil plus adjustment for preference share is 88 lakhs. So it becomes 2 crore 38 lakhs. Number of equity share outstanding is 25 lakhs in case of basic, plus in case of option 30,000, and in case of preference share is 40 lakhs. So 25 lakhs plus 30,000 plus 40 lakhs, it becomes 65 lakh 30,000. 2 crores 38 lakhs divided by 65 lakh 30,000, so it becomes 3.64. It was in decreasing pattern, so from 6 it becomes 5.93, then it becomes 3.64. So it is a diluted EPS. Now we have to give the adjustment for debenture. Now adjustment for incremental earning is to 1 crore 26 lakhs in case of debenture, and 24 lakhs is the number of shares in case of debenture, additional number of shares. Now total becomes 1 crore 50 lakhs is for basic calculation. For option it becomes nil. For adjustment for preference share is become 88 lakhs, and for adjustment for debenture become 1 crore 26 lakhs. So total becomes 1 crore 50 lakhs plus 88 lakhs plus 1 crore 26 lakhs, it becomes 3 crore 64 lakhs. Number of shares outstanding becomes, in case of basic, 25 lakhs, in case of option 30,000, in case of preference share 40 lakhs, in case of debenture 24 lakhs. So total becomes 25 lakhs plus 30,000 plus 40 lakhs plus 24 lakhs, it becomes 89 lakh 30,000. Earning per share is 3 crore 64 lakhs divided by 89 lakh 30,000. So it becomes 4.08. Is an increasing pattern. Previously, the earning per share is in decreasing pattern. Like from 6 to it becomes 5.93 after giving the option effect. After giving the preference effect, it becomes 3.64. Now after giving the debenture effect, it becomes 4.08. So it becomes increasing from 3.64 to 4.08. So it becomes anti-dilutive. If it is in increasing pattern, then it becomes anti-dilutive. It becomes, if it is in decreasing pattern, then it becomes a diluted EPS. As we had discussed in theory also, like we had discussed, if reduction in EPS is there, then it becomes diluted, and if there is increase in EPS, then it becomes anti-dilutive. If increase in loss per share, then it becomes dilutive, and if reduction in loss per share, then it becomes anti-dilutive. That the EPS is increasing from 3.64 to 4.08, so it becomes anti-dilutive. So in this way we will check whether the EPS is dilutive or anti-dilutive. From the books of Janet Limited, the following information is available. Fully paid equity shares of rupees 10 each, that is 1 lakh. Partly paid equity share of rupees 10 each, rupees 5 paid up, that is 1 lakh. Rupees 5 is paid up. Fair value of the shares is rupees 10 each. That is partly paid equity share. Option outstanding at an exercise price of rupees 60 per equity share of rupees 10 each. That is number of options is 10,000. The option exercise price is rupees 60 each. Now the fair value of equity share during both the year is rupees 75. 10% cumulative preference shares of 100 each. That is 80,000 conversion ratio. 80,000 is the number of preference shares. Conversion ratio is 2 equity shares for each preference share. 12% convertible debenture of rupees 100 each. That is 10,000. Conversion ratio is 4 equity share for each debenture. Income tax rate is 30% in both the year. On 1st October 2021, the partly paid shares were fully paid up. On 1st January 2022, the company issued one bonus share for every 8 share held on that date. Net profit attributable to the equity shareholder for both the years, that is year 1 and year 2, rupees 10 lakhs. We have to calculate the basic EPS for both the year, that is 2021 and 21-22, and adjusted EPS, diluted EPS of 21-22, and assuming the same information for the previous year also, and assuming that the partly paid shares are eligible for proportionate dividend only. Now in these illustration everything is given. Bonus component is given, partly paid equity shares component is given, option is given, preference shares convertible ratios is preference share is given, debenture is given, income tax rate is given, everything is given in this question. So firstly we will calculate the basic EPS for the 2021. So we will calculate the weighted average number of equity shares for the financial year 2021, because in financial year 2021 the partly paid shares becomes 1 lakh, because in which rupees 5 is paid. So in that case the fully paid becomes 50,000. The 1st April to 31st March 2021, 12 months period, time weighing factor is 12 divided by 12, number of equity share outstanding is 1 lakh, because fully paid equity share for calculating the basic EPS is 1 lakh and partly paid becomes 50,000, because 5 rupees paid up, so it become 1 lakh number of shares. So 50,000 are fully paid up. So 1st April 2022, 31st March 2021 becomes 12 months period. 12 divided by 12, that is number of equity shares is 50,000, because partly paid shares on 1 lakh share 50,000 is partly paid. So total becomes 1,50,000. For calculating the basic EPS for the financial year 2021, net profit is 10 lakhs. 10 lakh divided by weighted average number of shares is 1,50,000. So it becomes 6.67. For the financial year 2020, 21-22, that is on 1st October 2021, the partly paid shares become fully paid, and the company also issue a bonus share. So we will calculate the basic EPS for the financial year 21-22. Financial year, calculating the weighted average number of shares for the financial year 21-22. From 1st April 21 to 22, fully paid shares are 1 lakh. 1st April 21 to 31st March 2022, that is 1 lakh is the opening number of shares. For 12 months, time weighing factor is 12 divided by 12. Weighted average number of shares is 1. On 1st October 2021, the partly paid become fully paid. So from 1st April 2021 to 30th September 2021, that partly paid shares are there. 50,000 number of shares which are partly paid for 6 months. So 6 time weighing factor is 6 divided by 12. So number of equity shares is 25,000. 1 hour becomes 25,000. Now from 1st October, these partly paid shares become fully paid. 1 lakh share become fully paid, so it become 1 lakh from 1st October 2021 to 31st March 2022. So 1 lakh for a period of 6 months. So time weighing factor is 6 divided by 12. So 1 lakh into 6 divided by 12, so it becomes 50,000. 1 has become 50,000. So On 1st January 2022, the company issue one bonus shares for every 8 shares held. So how much bonus share they issue? The bonus is given to the existing shareholder. So outstanding number of shares, that is 1 lakh is the fully paid equity share, 10 each, that is 1 lakh number of shares are fully paid, and partly paid share is also 1 lakh, that is fully paid. So total number of shares, existing shareholders are 2 lakh. The existing shareholder will get, for every 8 share they will get 1 share. So 2 lakh divided by 8 into 1, so it becomes 25,000. So bonus component is 25,000 for a period, because it is to the existing shareholder. So 12 divided by 12 is the time weighing factor. So it becomes 25,000. Total vanas becomes 1 lakh plus 25,000 plus 50,000 plus 25,000. So time total weighted average number of shares outstanding becomes 2 lakh. Now basic EPS for the purpose of calculating for the financial year 21-22 is net profit after tax is 10 lakhs divided by weighted average number of equity shares, that is 2 lakhs, rupees 5 for the financial year 21-22. Now restate the basic EPS for the financial year 2021, because the bonus component is there in the financial year 21-22, and if we prepare the financial statement of the financial year 21-22, we have to restate the comparative figures, that is on 2021. So we have to restate the basic EPS for the financial year 2021 by giving the bonus effect. Restated EPS for the financial year 2021, total weighted average number of shares outstanding that we had calculated is 1,50,000, and bonus component, adding the bonus component on that, that is 25,000. Total number of shares outstanding after restatement, that is 1,75,000. Restated EPS, calculation of basic EPS for the financial year. Restated basic EPS for the financial year 2021 is net profit is 10 lakhs divided by restated weighted average number of equity shares, that is 1,75,000. So it becomes 5.71 is the restated EPS. Now we have to calculate the dilution effect, because dilution happens in both the years. So 10% cumulative preference shares of 100 each. So we will calculate the dilution of the financial year 2021. Firstly, computation of additional earning per incremental share to determine the ranking. Additional net profit after adjusting the tax or expenses in case of option outstanding at an exercise price of 60 per equity share. The fair value of both the shares option is given is 75. So we have to find out, because there is no incremental earning in case of option, so it becomes nil. Number of shares outstanding we have to calculate for the option. Now we have to check the working. In case of option, number of option exercise is 10,000, because the number of option exercised is, the exercise price is 60 and the fair value is 75. So 75 minus 60 divided by 75, so it becomes 2,000 number of shares. So additional number of shares included in calculating the diluted EPS is 2,000 in case of option. The convertible preference shares, 10% cumulative preference shares of 10 each, that is 80,000 number of shares are there. 80,000 number of shares is converted in the ratio 2 equity share for every 1 preference shareholder. So 1,60,000 becomes the number of shares which is converted from preference to equity. 1,60,000, and rest on that preference share, that is dividend for the year, becomes 80,000 into 100 into 10%. 10% is the rate of interest, rate of dividend, that is 8 lakhs. So 8 lakhs is the incremental earning in case of convertible preference shares. Now convertible debenture, that is 12% convertible debenture of 100 each, 10,000, that is 10,000 into 100 into 12% after tax is 70%, so it becomes 84,000. Conversion ratio for debenture is 4 equity shares for each debenture, so number of shares are 40,000. 10,000 into 4 divided by 1, so it becomes 40. Now we have to incremental earning per share. In case of option, it becomes nil. In case of convertible preference share, 8 lakh divided by 1,60,000, so it becomes 5. In case of convertible debenture, 84,000 divided by 40,000, it becomes 2.1. Now we have to calculate the bonus component on the convertible preference shares and convertible debenture. Additional number of equity shares included in calculating the diluted EPS is, that is 80 into 2 divided by 1,60,000. In case of convertible debenture, it becomes 40,000, that is 10,000 into 4 divided by 1, and bonus component on that 1,60,000 number of shares are there. Every 8 shareholder will get 1 share. So 1,60,000 divided by 8 into 1, so becomes 20,000. And in case of convertible debenture also, 40,000 divided by 8 into 1, so it becomes 5,000. These are the bonus component in case for calculating the diluted EPS. Now calculation of weighted average number of outstanding shares for diluted purpose during the year 2021 and 21-22. During the 2021 and 2021 and 22, so total weighted average number of shares outstanding, that is in case financial year 2021, as we had calculated after giving the weighted factor 1,75,000, and in case of financial year 21-22, it becomes 2 lakhs. Add bonus number of shares in case of convertible preference shares, as we had calculated. In case of convertible preference shares, it becomes 20,000 in both the year and 5,000 in case of debentures. Because we are restating the diluted EPS, so we have to calculate the restatement also for total weighted average number of 2 lakh in the financial year 2021, that is 1,75,000 plus 20,000 plus 5,000, it becomes 2 lakh. And for the financial year 21-22, it becomes 2 lakh plus 20,000 plus 5,000, it becomes 2 lakh 25,000. Weighted average number of shares outstanding for dilution purpose. Now we have to calculate the diluted EPS for the financial year 2021, 2022, and the adjusted EPS, restated diluted EPS. Firstly, we will calculate the normal diluted EPS for the financial year 21-22. That is, profit attributable to equity holder is 10 lakh, and for 21-22, it becomes 2,25,000. As how it becomes 2,25,000, as we have calculated in our calculation, so it becomes 2,25,000 for the financial year 21-22. For dilution effect, 10 lakhs divided by 2,25,000, so it becomes 4.44. Reportable diluted EPS for the 2021, because 10 lakhs is the profit in both the years, and reportable EPS is 1,50,000. So 10 lakh divided by 1,50,000, so it becomes 6.67. Now adjusted diluted EPS, that is restated diluted EPS for the financial year 2021, becomes, as we have calculated after giving the bonus impact of all the shares, normal bonus impact, and also convertible preference shares and convertible debentures, so it becomes 2 lakh. So 10 lakh divided by 2 lakh, so it becomes 5. 5 is the EPS. Now we have to give the adjustment for option, as there is profit attributable to equity holder is nil. Diluted number of shares in case of option becomes 2,000. Total after option adjustment becomes 10 lakhs plus nil is 10 lakhs, and number of shares becomes 2,25,000 plus 2,000, that is 2,27,000. 10 lakh divided by 2,27,000, it becomes 4.41. So from 4.44, it reduces to 4.41. So it becomes a diluted EPS because it is in reducing nature. Now in case of reportable diluted EPS for the financial year 2021, the number of shares becomes 1,50,000 plus option is 2,000, so 1,52,000. So 10 lakh divided by 1,52,000, it becomes 6.58. It is also a diluted EPS because from 6.67 it reduced to 6.58. Now adjustment, restated diluted EPS for the financial year 2021, that is 2 lakhs plus 2000, it becomes 2 lakh 2000, and 10 lakh divided by 2 lakh 2000, it becomes 4.95. It is also a dilutive EPS because from 5 it is reduced to 4.95. Now adjustment for preference share is also given. Incremental earning is 8 lakhs. Number of shares becomes for the financial year 2021-22, it becomes 1,60,000. So total becomes 10 lakhs plus 8 lakhs, it becomes 18 lakhs after giving the preference effect, and the number of shares is 2,27,000 including options, and first preference shares is 1,60,000, so it becomes 3,87,000. Now EPS becomes 18 lakh divided by 3,87,000, it becomes 4.65. Now from 4.41 it is in increasing in nature. From 4.41 it increases to 4.65. So it was an anti-dilutive EPS. Anti-diluted EPS in the financial year 21-22. Reportable diluted EPS for the financial year 2021, 1,50,000 plus 2,000 plus preference share adjustment is 1,60,000, so it becomes 3,12,000. 18 lakh divided by 3,12,000, so it becomes 5.77. It is in reducing nature, that is 6.58. It reduced to 5.77, so it is dilutive in nature. Restated EPS for the financial year 2021. So 2 lakh 2,000 is the after giving the option effects and plus adjustment for preference shares is 1,60,000, so it becomes 3,62,000. 18 lakh divided by 3,62,000, so it becomes 4.97. It is also anti-dilutive because it is in reducing nature. From 4.95 it increases to 4.97, so it is in increasing nature, so that's why it is an anti-dilutive. Now we will give the adjustment for debenture. Incremental earning in case of debenture is 84,000. So 18 lakhs plus 84,000 become 18 lakh 84,000. Number of shares increases in case of debenture is from 40,000. So 3 lakh 87,000 plus 40,000, it becomes 4 lakh 27,000. After giving the debenture effect, the EPS becomes in the financial year 21-22, that is 4.41. It is also dilutive because it is decreasing in nature. From 4.65 it decreases to 4.41. It is dilutive in nature. Now in reportable diluted EPS for the financial year 2021, 3 lakh 12,000 plus 40,000, it becomes 3 lakh 52,000. 18 lakh 84,000 divided by 3 lakh 52,000 becomes 5.35. It is decreasing in nature, that is from 5.77 it decreases to 5.35, so it is a dilutive EPS. Now in case of restated diluted EPS for the financial year 2021, 40,000 is the number of shares in case of debenture, so 3 lakh 62 plus 40, it becomes 4 lakh 2,000. Then 18 lakh 84,000 divided by 4 lakh 2,000, it becomes 4.69. It is also a dilutive in nature because it decreases from 4.97. Now determining the sequence for computing diluted EPS. Theory related to the sequence for computing diluted EPS. Firstly, we will compute for each potential ordinary share additional net profit after adjusting tax expenses, if any. Like we had calculated, in case of preference shares, the additional income is. Now in step 2, we will additionally potential diluted ordinary shares issuable. Potential diluted number of shares is 1,60,000 in case of preference shares, 40,000 in case of debentures, and 2,000 in case of option, which we had calculated. Now we will calculate the earning per incremental share, ordinary share, that is, we will divide the additional net profit with the additional number of shares, potential diluted ordinary shares. So we will get the earning per incremental share. Now we will rank the various types of potential ordinary shares based on step 3. First rank is given for least earning per incremental ordinary share, and so on in ascending order. Like whether they are dilutive or anti-dilutive, it depends on the decreasing or increasing nature of the EPS. Compute diluted EPS in the following manner, and then we will compute basic EPS, add net profit, an additional share for each type of potential ordinary share in the ordinary ascending order described above. Calculate diluted EPS at each stage. Select least diluted EPS which shall be reported. If diluted EPS increase in any stage, that type of potential ordinary share will considered as anti-dilutive. As we have discussed, if it is in decreasing nature, then it will be dilutive. If it is in increasing EPS, like in this case, from 4.95 it will increase to 4.97, so it becomes anti-dilutive. And from 4.97 it decreased to 4.6769, so it becomes dilutive. So if it is in decreasing nature, then it is dilutive. If it is in increasing nature, then it will be anti-dilutive. At 30 June 2021, the issued share capital of an entity considered of rupees 15 lakh ordinary share of rupees 1 each. So rupees 15 lakh ordinary share of rupees 1 each means number of shares becomes 15 lakh only. On 1st October 2021, the entity issued rupees 12,50,000 of 8% convertible loan stock for cash at par. Each rupees 100 nominal value of loan stock may be converted at any time during the year ended 2026 to 2029 into the number of ordinary shares set out below. 6/2026 it becomes 135 ordinary shares. On 30/6 2027 it becomes 130 ordinary shares. On 30/6 2028 it becomes 125 ordinary shares. On 30/6 2029 it becomes 120 ordinary shares. If the loan stock are not converted by 2029, they would be redeemed at par. These illustrations assume that the return equity conversion option is accounted for as a derivative liability and mark to market through profit and loss. Changes in the option fair value reported in 2022 and 2023 amounted to losses of rupees 2,500 and 2,650 respectively. In 2022, there is a loss of 2,500. In 2023, there is a loss of 2,650. It is assumed that are no tax consequences arises from these losses. The profit before interest, fair value movement and taxation for the year ended 30th June 2022 and 23 amounted to rupees 8,25,000 and 8,95,000 respectively. Relates wholly to the continuing operation. The rate of tax for both periods is 33%. Calculate basic and diluted EPS. Solution: net profit before interest, tax and fair value adjustment is on 2022 it becomes 8,25,000 and on 2023 it becomes 8,95,000. That is net profit before tax, interest and fair value adjustment. So it becomes 8,25,000 in 2022 and 8,95,000 in 2023. We will reduce the interest expenses because this is the profit before interest, before tax and before fair value adjustment. So interest is on 12,50,000, 8% interest for a period because it was issued on 1st October 2021. So it is for a period October, November, December, January, February, March, April, May, June, because in this case 30th June 2021, June is the financial year ended. So 12,50,000 into 8 into 9 by 12. So it becomes 75,000. But in case of 2023, 12,50,000 into 8%, so it becomes 1 lakh. It is for a period of whole year. Now net profit before tax and fair value adjustment, 8,25,000 minus 75,000 in case in year 2022. It becomes 7,50,000 in 2023, 8,95,000 minus 1 lakh, it becomes 7,95,000. Now tax rate is 33%, 7,50,000 into 33%, it becomes 2,47,500 and in 2023, it becomes 7,95,000 into 33%, it becomes 2,62,350. So profit after tax 7,50,000 minus 2,47,500. So it becomes 5,02,500. And in 2023 it becomes 7,95,000 minus 2,62,350. So it becomes profit after tax becomes 5,32,650. Less fair value loss is 2,500 in 2022, and 23 it becomes 2,650. So net profit attributable to equity shareholder becomes 5,02,500 minus 2,500, so it becomes 5 lakh. In 2023, 5,32,650 minus 2,650, so it becomes 5,30,000. Weighted average number of equity shareholder outstanding is 15 lakhs in both the case. So basic EPS is in year 2022 5 lakh divided by 15 lakh, so it becomes 0.33 per share. And in 2023 5,30,000 divided by 15 lakh, so it becomes 0.353 per share. So we had calculated the basic EPS. Now we will calculate the diluted EPS. Calculation of diluted EPS. So we will calculate the diluted EPS. Particulars: net profit before fair value adjustment. Before fair value adjustment for the year 21-22, it becomes 5 lakh 2,500, and 22-23 it becomes 5 lakh 32,650. Add additional earning on convertible loan stock after tax. Additional earning becomes, because in this case the 12,50,000 is the loan stock, 8% is the interest on that for a period of 9 months. So 9 divided by 12, and after tax it becomes, because 33% is the tax rate, so after tax it becomes 67%. So additional earning is 50,250. So total becomes, adjusted net profit becomes 5,02,500 plus 50,250, so 5,52,750. Diluted weighted average number of equity share becomes 15 lakhs is the number of shares outstanding, plus 12,50,000 is the 12,50,000 divided by 100, because the total value of loan stock is 12,50,000 and the nominal value per loan stock is 100. 12,50,000 divided by 100, and we will divide the maximum number of ordinary shares. In this case, in 30 June 2026, the maximum number of ordinary shares issued by the entity is 135. So we will take the maximum number only. So maximum number is 135. 12,50,000 into 135 divided by 100. So number of shares becomes 15 lakh plus 16 lakh 87,500 for a period 9 divided by 12. So total number of weighted average equity share is 15 lakh plus, that is 27 lakh 65,625. Diluted EPS become adjusted EPS divided by diluted 1 hours, that is 5,52,750 divided by 27 lakh 65,625. It becomes 0.20 per share. 22-23 net profit before fair value adjustment is 5,32,650. Additional earning on convertible loan stock after tax is 12,15 to 8% into 67% is the tax rate after tax. So it becomes 67,000. 5,32,650 plus 67,000, it becomes 5,99,650. Diluted weighted average number of equity shares is 15 lakhs plus 12,50,000 into 135 divided by 100 into 12 by 12, so it becomes 31 lakh 87,500. Diluted EPS is adjusted net profit divided by diluted 1 hours, so it becomes 5,99,650 divided by 31 lakh 87,500, so it becomes 0.19 per share. Now presentation of EPS, how we will present. For diluted EPS calculation, consider only free or bonus element present in the option. Free element means share issued on exercise of option. Size of option minus number of option into exercise price plus average market price. These free elements would be added to the denominator. Options generally do not involve any payouts in the form of interest, dividend, hence adjustment to the numerator would generally be nil. However, if the options are measured at fair value through profit and loss account, fair value gain or loss would be adjusted in the numerator. In case of option, adjustment is to be done. Thanking you for watching my video. If you like, please share, subscribe my channel.